Good morning from our world headquarters in New York. I'm Manus Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Crisis averted. Kevin McCarthy secures a last-minute bipartisan deal to keep the government open, but triggers a mutiny to depose him as House Speaker. The Bank of Japan intervenes again to curb decade-high yields. Yen hits a new one-year low. And Jerome Powell and Christine Lagarde both speak this week as investors brace for a deluge of data with jobs jolts in focus. A very good morning to you. So last week, have you recovered from your PTSD in the bond market? It was quite literally a hurricane of revaluation on inflation and higher for longer. This morning, we start with the shutdown that has been averted. And so we're back to basics. What will Powell say to the market today? Yields march higher and the shorts are mounting in this market. You're the biggest quarterly loss since 2009. We're now down to a 1 in 3 chance of a hike in November. What will Powell say to reset the tone? In terms of dollar yen, this is where you really want to focus. The Bank of Japan intervenes to stymie that rise in yields. You can see it at the bottom of your screen. The last time we saw this kind of intervention was last week. We're at a decade high in JGBs. This is the market testing the JGBs, testing dollar yen. It really, the more and more that they go, the Ministry of Finance, to try and take out 150. Does it expedite a faster reversal from yield curve control is what we can ask Kit Juckes a little bit later on today. The Finance Minister reiterates he is watching the currency closely. And I just thought for a little bit of a frisson, a little bit of a change, Monday morning, why not have a little bit of Bitcoin? You've got 6 weeks of inflows into this market. The speculation is that the SEC will approve BlackRock's Bitcoin ETF. By the way, last quarter you lost 11% on Bitcoin, and there was a huge withdrawal from that market. $500 million came out in the last 9 weeks. Bit of Bitcoin, Danny, good morning.
Good morning, Manus. I think today's going to be a good day because I can't remember the last time you did Bitcoin. That's a treat. I like that. Getting a little bit risky today. Why not? Look, I've got some of the rest of the risk markets here. I've got equities. I think equities are going to be really interesting this October. After a very bad September, after the worst quarter in a year, can they rebound or will that bearish momentum continue? At least for Europe, it is. European equities mostly unchanged, but ever so slightly into the red. But we are on the upside for S&P and NASDAQ futures, where we may be just all too bared up about a government shutdown. Does the relief of that, the kicking the can down the road, does it allow us to rally, and especially in the NASDAQ? But you got to imagine there's a lot of threats, especially as yields pump higher. And Manus, to this point, I want to talk about today's big take, and I big take go on the terminal. It's excellent. It's from the Bloomberg economics team, who say that every other recession over the past 4 decades, everyone was calling for a soft landing heading into it. So their base case is a recession, writing a soft landing remains possible. Is it the most likely outcome, though, with the U.S. confronting the combined impact of Fed, strikes, student loan repayments, oil prices, and a slowdown? Manus, they think not.
Well, I mean, no landing, hard landing, quasi-hard landing. Either way, if you then take that statement, so no soft landing, take your Larry Fink statement that you're now looking at structurally embedded inflation that he hasn't seen for decades. I put it back to you and I say the environment then goes back to the narrative of stagflation. If it's going to be harder than they all think, inflation's going to be higher and rates are going to be higher for longer. Does that really give you, as Alliance Bernstein said last week, 2.5% on bond yields or not? Stagflation, again, will be a key part of our discussion. But, Danny, let's reset. The U.S. narrowly averted, as you said, that disruptive and costly shutdown as Congress passed a compromise piece of legislation to keep the government running at least until November the 17th. Hours later, President Joe Biden urged House Speaker Kevin McCarthy to follow up quickly with support for Ukraine.
I fully expect the Speaker to keep his commitment to secure the passage and support needed to help Ukraine as they defend themselves against aggression and brutality.
Joining us now is Kathy Ackley from Bloomberg Government. Kate, good to see you this morning. So we're going to be having these same last-minute theatrics in November. This is just extend and pretend for 40-odd days, isn't it?
Right. This was just, like you said, kicking the can down the road till mid-November, where we're going to have this fight again. But in reality, the fight begins today. Congress had sort of a whirlwind weekend. It could have been a much longer weekend, but they averted the shutdown on Saturday night with the Senate passage of the continuing resolution to keep the government funded until November 17th. So now there's going to be a challenge, it looks like, to House Speaker Kevin McCarthy's position. He's got, conservatives in his conference who want to oust him, led by Florida Republican Congressman Matt Gaetz. So that is something, that's how we're going to kind of start the week off here in Washington. And, there are personalities, involved here. It's a personality fight, but it's also a fight over funding for Ukraine and just a whole number of other things.
Kathy, to that point, we have some sound from House Speaker Kevin McCarthy. He spoke to CBS Face the Nation over the weekend. Let's take a listen to that.
He's more interested in securing TV interviews than doing something. He wanted to push us into a shutdown, even threatening his own district with all the military people there who would not be paid, only because he wants to take this motion. So be it. Bring it on. Let's get over with it, and let's start governing.
So he's speaking about Gaetz there. Kate, if McCarthy goes, what does a likely replacement look like?
Well, first of all, either way, whatever is going to happen is going to have to look like what it looked like the House bill on Saturday. And it's going to have to be bipartisan. It's going to require Democrats. So if Congressman Gaetz is going to be successful in ousting McCarthy, he's going to need Democrats to help him do that. If McCarthy is going to stay on, he's going to need Democrats to help, vote for him or vote present or, somehow make it so that he's able to stay. So that's the first step. Something is going to be sort of in a bipartisan fashion. Who might replace him? That's not something that a lot of people are talking about because, there've been discussions that somebody in his current leadership, Whip Tom Emmer, who's a congressman from Minnesota, could be. Emmer has said, I don't want the job. So that's another problem is you got to find somebody who wants the job. Is there going to be some sort of consensus pick that Democrats and Republicans coalesce around? That's a tall order, and we'll see what happens.
It certainly is, Kate. Thank you very much for joining us for Waking Up Early. Kate Ackley of Bloomberg Government, thank you so much. And tune in later to our interview with Congressman Matt Gaetz on balance of power. That will be 5 p.m. Eastern. So what does all of this mean for markets? Joining us now is Kit Juckes, head of FX strategy at SocGen. Kit, I know you're writing before that should we get this shutdown, it would start the downtrend of the dollar. So is this dollar downtrend avoided then?
It makes it harder for it to happen right now. I think, look, you've got lots of things happening at the same time. We've had 2 really bad months for risk sentiment that's helped the dollar. We've had weak equity markets have helped. We've had a sort of a spate of continuously weak data in both Asia and Europe that have helped the dollar. And you've seen as a result of that, the positioning has sort of taken the dollar higher as people have got out of euro longs and then into, I think, a big, broad consensus long dollar position. So at the end of last week, part of me thinking, well, OK, what does that give for this week? But it sort of just throws us back to the biggest driver of all, which is this huge rise in Treasury yields as the vigilantes take over, because the one thing that's not going to stop is Treasury issuance. We're going to have to find the clearing price for all these bonds and notes. And if the next place we go is 460 on a 475 on a 10-year note, then the dollar's going up. And I think there are vigilantes in charge. And I'm looking at it this morning thinking, OK, we popped up to a new high because the shutdown was postponed. But we're still where we were. Really, something has to happen to make more people want to buy more bonds. And if the Chinese can't buy any because they're too busy doing something else and the Japanese are selling them because they're doing something to help their currency, that'll all just make it harder.
Kit, good morning to you. The voice of doom there on a Monday morning. 475 on the 10-year notes. The Japanese aren't buying, and the Chinese are reluctant owners of treasuries, in actual fact, divestors. OK, take me to 475. What does that do to risk? Because this market has not quite grasped. Last week, there was a hurricane went through the bond market. But if we're going to 475, Kit, what happens to overall risk at that kind of level? How soon could we get there?
I think it depends how fast it goes. I mean, we've had these yields and higher yields lots of times in the past. I don't think it necessarily does. You've got to remember, the overall risk sentiment is possibly the most resilient bit potentially after two such bad months. I've never been able to forecast equities, never understood them, but I wouldn't necessarily think they go on getting sold off. But let's put it this way. I think there's a better chance that risk sentiment stabilizes enough for emerging market currencies to get a little bit of a bid than we get the kind of good enough risk sentiment to make you think euro-dollar's going back up.
Kit, if you were excellent at forecasting equities, I think you'd need a different job, right? So I think that's okay. I think it's fine we stick to FX.
It's the only market I haven't done. Let's put it that way. There's a reason I don't do it.
Okay, fair enough. Okay, so you talked about the spending of the government. That's not going away anytime soon. What about the spending of the consumer? Could that be the thing that cracks and brings yields lower?
Well, yeah, eventually it will, right? So this is, so there is a degree to which what's been driving the U.S. economy is there was so much fiscal largesse, put so much money in so many bank accounts, and it still hasn't run out. And there's a labor market that's so tight that keeps that going because it keeps wages up and keeps the whole system going. There's a sense that, a landing is inevitable because this all does come to an end. And the politics just risks a harder landing than otherwise. But the landing takes time. I know we've got a forecast of a recession in the middle of next year. Just all along it seemed like people either said there's never going to be one or it's got to be tomorrow. And so I think we can crawl on for a bit. But the question is whether you turn the data around fast enough to really sort of move it. Because if you get a slightly softer numbers, you're not changing the story very much.
And part of that narrative for you is that, you're going to see more rate cuts coming through next year, and that really gives full steam to the dollar's demise. I want to put this to you from Martin Malone, who was with Danny and I last week, and he talks about the Volcker era. 1982 was successful for Volcker. He quashed inflation, but they needed an inflation, which was worse than the 1930s depression. Note, inflation reaccelerated to 5% in 1984 and 6% in 1990. That is the single biggest risk here, Kit, isn't it? That there is some kind of an reacceleration into 2024. Do you see that as a real risk and an underpriced risk?
Yes, it's a risk in the sense that, that it could happen. That I've been surprised that so many bits of the labor market have bargaining pressure. That there's so many things that are that seeing inflation try to come back. I think on balance, what you'd think is you'll get you'll get some mini cycles higher inflation, and then we'll get it back under control. I still think the global economy's changed shape enough that what we mostly consumer services and the additional cost of producing them is low enough that we're not going to go back, certainly so, to an echo of the 70s, which is what those sort of 80s recession cycles were. But most of all, all our experience of inflation is based on one period in history.
Yeah.
That's it. So we write books and pretend we get PhDs and we have one relevant period to go with.
You are just putting people out of business left and right. Hold those thoughts. We're going to get back to you. We have a lot more to cover. That's SocGen's Kit Juckes, who's going to stick around with us. All right, let's get to some of the stories that we are tracking on the terminal this morning. California Governor Gavin Newsom will appoint LaFonza Butler to fill the remainder of Dianne Feinstein's term, making her the only black woman in the U.S. Senate and just the third in its history.
And of course, we've got China's manufacturing its activity returned to expansion in September for the first time in 6 months, a sign that stimulus may be taking root. Of course, China's closed for Golden Week this week. Danny.
And then at the same time, the Bank of Japan announced an extra bond buying plan for this week, following an unscheduled operation it conducted on Friday. Now, coming up, we're going to discuss just that, the yen, the BOJ, with Kit Juckes of SocGen. He's sticking around with us. Also, coming up later this hour, we're live from the ADIPEC Energy Conference in Abu Dhabi with S&P Global Vice Chair Dan Yergin. And then later today, Bloomberg's Emily Chang sits down with JP Morgan CEO Jamie Dimon for an exclusive interview. That's 10 a.m. New York time, 3 p.m. in London. This is Bloomberg.
This is Bloomberg Brief. I'm Manus Cranny in New York, Danny Berger in London. Danny, there's a stairway to heaven. It was written a few years ago. Well, there's a stairway to 150. Have a look at dollar yen. We've got a conundrum which is trying to battle those rising yields on the 10-year, which is the objective of the Bank of Japan, 0.775, last seen in 2013. Here we are almost kissing the 150. Can they have both? Can they have their cake and eat it? That's the question that goes through my mind, which is defend the yields and not have a weaker yen. Kit Juckes can answer that since he is FIC specialist of the Monday trade. Come on, you have doom and gloom in the A block. Let's go for what's going to happen here. How hard does the Bank of Japan defend this line in the sand, Kit? Good morning.
Good morning. I don't know how hard they defend it, but my mother told me I couldn't have my cake and eat it enough times that I got the message. You can't have your cake and eat it. So if you're going to try to keep JGB yields down, dollar yen will go through 150. And if you're trying to keep dollar yen, which can go through 150, and keeping yields down, you have to spend an absolute something amount of money on intervention. And is it credible? Because in the end, if your intervention isn't credible, what do you achieve? So I think the Japanese are in a terrible corner. They've got themselves in a position where it looks like they're going to make policy changes in December, and that's only 2 months away. So the chances of us not going through 150 on dollar yen seem to be quite high. What they do with the JGB market, yes, a bit more intervention of one kind or another, but it makes no sense.
Well, I mean, that is the question that comes to my mind. Why would they continue to do that? Why would they continue to buy bonds if they know it's just going to equate to a weak yen? Because
they have a target for yields and a desire not to see the yen weaken.
How do they get out of this corner then? They pin themselves in.
They try to have their cake and eat it like every 13-year-old boy does until his mother tells him, you can't do it anymore.
So what gives here? I mean, there's two massive dams at play here. One is 150 and one is, let's call it 0.80 in the bond market. We had somebody with us last week who said they see multi-year high in the dollar, 200 to the yen against the dollar. If we break 150, we're just throwing it out there for Martin Malone, really. But if you do break 150, how hard will the FX boys and girls push it?
They'll push it. I mean, I think, in a line... In a sense, 150 is just a number. 150 is followed by 155, followed by 160. I'd be surprised if you get as far as 160, something will break. But if the Chinese let the yuan go, it'll make it harder. The yen is very cheap. Actually, the cheapness of the yen, I mean, you had a Tankan this morning that on some measures was back to kind of place it was in the early 90s. So this is going to do something. This is going to do something. The yen is cheap. And apart from everybody booking their holidays to go to Japan when cherry blossom turns up again next May, the currency is competitive here, and that will matter. But I think that I don't think you get a big speculative attack because you're at this extreme level. I just don't think you can turn it round or defend artificial levels unless you get your policy ideas lined up. And if the policy idea is it's too soon to end low yields, intervention, and the things we've got, then that means you have to let the currency weaken further.
Can I just say I was one of those people this past May. I did go see the cherry blossoms in Japan. So I've done my part. I washed my hands of it.
Even cheaper next year.
Okay, good to know. That's a good call. I'll book my trip now. Kit, the data coming out this morning from the BOJ, from the Tenkan, that Japanese companies see 2.5% year-over-year inflation in 1 year. Is it too soon? Is it too soon to abandon negative rates if that's what we're starting to see come out of companies?
I mean, it depends how conservative expectations can move around faster than people who. I mean, the Japanese, we have to be sympathetic to the fact that this is a multi-decade deflationary hole that was born in the 1980s. So, premature exit from that catastrophe would be a really big historic mistake. But I wouldn't wait till December.
OK, there you go. That's the call from Kit Juckes. Don't wait till December to pull the cord on YCC. Suck Jens. Kit Juckes with his calls this morning. A quick check on markets for you. There was a hurricane pass through the bond markets. Kit Juckes says the vigilantes are still in charge. 475 is eminently potential on 10-year government bond yields. Yields are rising across the world from Germany, the UK, where there's no room for tax cuts from Jeremy Hunt. More on that in a moment. 449. Good morning from New York and the bond market.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. The United Auto Workers and Detroit's Big Three automakers are still locked in negotiations over a new contract, including pensions and pay rises. The union is expanding its strike against GM and Ford to more assembly plants, but is sparing Stellantis from additional walkouts. Ford CEO Jim Farley is accusing the UAW of holding talks hostage over issues not governed by their contract. So, Manus, the strikes continue on.
Yeah, and you just think they're grappling with this transition to electric vehicles, and at the same time, we're going to get Tesla. They're going to tell us today how many they delivered in the quarter. And I think it's interesting, if you look back at the start of the year, Danny, what was it Elon promised us? 2 million cars. That's what was promised at the start of 2023. And, of course, he reverted to that lower target of 1.8 million cars in the middle of the summer. So what are we looking for, Danny, in terms of the numbers for the third quarter?
So third quarter, the expectation, Manus, I've got this to the single digit, 456,722 cars. I realize no one's going to remember that number I just sent out to you, but basically it's lower than last quarter. This would be the first decline since early 2022 in deliveries at the time that they're cutting prices, Manus.
Yeah, look, by the way, I listen to every number that you throw across the pond at me. Look, by the way, if you're Tesla, I mean, they are the benefits of the Inflation Reduction Act. You can get your discount on your EV there. Your federal tax credit, $7,500. Okay, a little bit more on the energy front, but this time from the petro side. We got Yergin, S&P Global Vice Chairman, live from ADIPEC in Abu Dhabi on Bloomberg. Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. Crisis averted. Kevin McCarthy secures a last-minute bipartisan deal to keep the government open, but triggers a mutiny to depose him as House Speaker. The Bank of Japan intervenes again to curb decade-high yields. Yen hits a new one-year low. And Jerome Powell and Christine Lagarde are both due to speak this week as investors brace for a deluge of data from jobs and jolts in focus. Equity markets had a very bad month last month, a very bad quarter, the worst quarter since 2022. The direction of these next couple weeks will be crucial. Is that downward momentum going to continue, or were we too bared up on things like a shutdown? That's maybe why we're seeing some relief from S&P and NASDAQ futures, up at least 0.5% in the case of the NASDAQ. Europe, it's a different story. We're moving lower this morning. We're down about 1/3 of 1%. It's the diverging fortunes between a still strong and hopes for a soft landing American economy and Europe, where the data is weak. But Manus, I know you're about to show me some higher yields. So I look at something like the NASDAQ outperforming, and I really got to question its lasting ability if yields are going higher.
Well, yeah, I mean, we just had a conversation with Kit Juckes where he says that he thinks that the dollar ultimately will top out into next year. You're going to see rate cuts, but he also makes some pretty strong calls to challenge that sustenance that you've got in the NASDAQ this morning. If you look at yields, we're trading higher, and we are trading higher globally this morning. So it's not just U.S. yields. You've had real PTSD from last week, and Kit says you could eminently make it to 4.75% on bond yields. The vigilantes are in charge. That hurricane has not gone away. There are more spikes in yields to come, potentially up to 4.75 in the US. I put Bitcoin on the board. I just thought we'd show you a little bit of light relief. You're looking at a nice set of inflows. There was a divestment of up to $500 million in the past 9 weeks, but you had a drop of 11% in the last quarter. But there is a potential that the SEC could approve BlackRock's ETF, the Bitcoin ETF for BlackRock. So you're just seeing this sort of slight resurgence in the likes of NASDAQ, the likes of Bitcoin, because there was that battering last week. When it comes to dollar yen, you cannot have your cake and eat it. That is a view from SocGen. You can't defend JGBs, which are at the bottom of your screen, which is step in and really stymie the rise in yield, and at the same time hope that you can defend dollar yen. 150 is going to be taken out. If you continue to try and defend the yields, 150 will be taken out very soon. And it's not a question of where dollar yen will go to. It's just a question of, it's a punching bag, really, isn't it? To try and gut punch dollar yen until you see when does the Ministry of Finance actually roll over and fold. Danny.
I think Kit referred to the BOJ as a little boy who wanted to have its cake and eat it too. Look, some fighting words from Kit Juckes, who also said that waiting until December to act for the BOJ would be too long. They've got a decision in October, Will they move?
You see, I left you a bit of cake on the plate. You see? There you go. Well, let's talk about crude prices because they're tracking towards $100 a barrel. Saudi Arabia, the Saudi Arabia-led coalition, the OPEC supply cuts. The Middle East will play host to the region's largest energy conference. Let's get to ADIPEC now for the energy conference in Abu Dhabi. Yusuf Gamal Eldin is on the ground there with the S&P Global Vice Chairman, Dan Yergin. Yusuf, good morning.
Good morning, Manus. Good morning, Danny. Yes, it's been a very busy few hours. I mean, everybody's standing shoulder to shoulder, getting into the debates around the energy markets, and we want to chip away at that with Dan Yergin, who joins us here around the set. Dan, I mean, WTI at $90 a barrel, Brent at 92. We're coming off the highs of last week. Still been a monster previous quarter of a rally of 29%. When you look at the fundamentals, when you look at the technicals, is there enough muscle to keep the prices at the current levels, let alone push it sustainably into triple-digit territory?
Well, on the one hand, of course, you have a tight market, supply cuts, also inventories are low. On the other hand, it's still the overhang of the interest rates and what's going to happen to GDP growth. And that's where the tension is coming, and you can see the oil price bouncing between those two things.
I was looking through a note from Citi in the last couple of hours. Ed Morse, who you're very familiar with, he's saying oil prices are going to collapse to $70 a barrel in 2024. The surplus is going to come back, and basically you're going to have a complete turnaround in sentiment as well. Is that something you can foresee as well at this point?
I think so much depends upon economic growth, whether that happens or not. But you're going to move into a quarter where demand is going to be weaker anyway, and that's going to be weighing on the price. Whether it's going to collapse or not, you know, it's tell me what's going to happen to Chinese economic recovery.
One of the things that has been spoken about quite a bit here, both on stage and off stage, is energy policy within OPEC Plus. And Saudi Arabia has kind of taken the lead with their unilateral cuts. They've extended those to year-end to 1 million barrels per day. How worried are you that the Saudis may be over-tightening given the fragility of the global economy?
Well, I wouldn't say that I'm worried about it. I think what they've done is they want to put a floor under the price of oil, and it's been a pretty high floor. And also they wanted to bring down inventories. So, I mean, that's what they've done. You know, how long that holds for and what's going to happen next year. I mean, the big issue that people are not talking about in the oil market is the strength of non-OPEC plus oil. The growth in the United States this year is 1 million barrels a day. Brazil, Canada. Canada is going to grow 500,000 barrels a day next year. And so it's basically is that the non-OPEC plus oil is growing faster than demand. That's the factor that goes unremarked in the discussion about oil prices.
When I look at production capacity across OPEC plus, I see that they're at levels that we haven't seen in a few years. You've seen several cycles of both higher and lower production capacity. What are the immediate implications for the market?
Well, I think that obviously for the producers, it's about revenues, and then you have the whole complication about the war that's going on, and the fact that you have a divided oil market now with Russia that's kept its production up. And so that's what kind of the market is struggling with. And I think that's what's different, that, you know, that energy markets are not the way they were on February 23rd of 2022.
You mentioned non-OPEC oil, and I look at the United States. The strategic petroleum reserves have not been refilled. Energy is going to be arguably top of the agenda for the political contest in 2024. How high do you think it will rank in that debate?
It depends on one thing.
What's that?
Gasoline prices. And you heard Joe Biden the other day saying, I promise you I'm going to bring down gasoline prices, because, I mean, anybody running for office knows that that is a very volatile issue in American politics.
You think the Americans can persuade the Saudis to add a few more barrels in a sort of a grand bargain with Israel, maybe kind of security arrangement? Because, you know, that seems an opportunity for the administration to take.
Right. I think that the kind of oil policy is marching its own track. However, if you get to this mega deal, all these other aspects are happening, and it's a very complicated mega deal, then clearly oil prices would be part of the discussion as well.
What is your sense is the pain threshold for gasoline prices? I mean, where At what number you think it's going to be more of an issue?
I think as it gets around.
Are we there yet? We're getting close, aren't we?
Close. I think around $4 a barrel is when you start to hear about it, because Americans, they drive a lot of miles to get to work. And by the way, that affects the Democratic voters.
Okay. What about peak fossil fuel demand? The IEA has been out and about, and they're pushing their report saying that we're going to see that peak this decade. Does Dan Yergin think that's realistic? I see a smile there.
I don't. I think at this point it's still the view that I have in the new map that oil demand peaks around 2030 or the early 2030s. I mean, it was 100 million barrels a day. Now we're close to 104 million barrels a day. I think, again, it will depend upon what happens for growth in terms of the emerging markets. So somewhere there's a peak. By the way, the peak doesn't mean it's going to collapse. It means that it's going to start to flatten out on the other side.
I want to return to a couple of more things. What do you expect OPEC Plus to do this week? Do you think they're just going to, stay the course?
I think stay over. I don't see any sign that they're going to make any dramatic change.
And the other thing that stood out to me and many others is that they are trying to add the climate component to what is essentially has always been a petroleum conference, decarbonization across the energy and supply chains. How would you quantify the progress that's been made by the United Arab Emirates thus far in that direction?
Well, I think in the United Arab Emirates, it's clearly on one hand they are a growing oil producer, but on the other hand, they've made a big commitment on decarbonization. And we had a meeting yesterday with a whole industry group, and the whole theme was decarbonization. What are the technologies to do it? And I think that that's going to be a big thrust here, of course, going into COP28, because they want a COP that's going to be not words but action, and decarbonization is the theme that runs through everything.
What do you make of the apparent contradiction about the UAE being an energy producer versus them hosting COP?
Well, I think it's reality. In fact, 80% of the world's energy is hydrocarbons, and the hydrocarbon industry needs to be part of it. And every company, I was just listening to all these CEOs yesterday, they all have putting billions of dollars into decarbonization, whether it's going to be biofuels, whether it's being carbon capture, whether it's going to be hydrogen, whether it's electrons or molecules. That's where increasing effort's going to go.
Dan, terrific to compare notes as always. That's Dan Yergin, the Vice Chairman of S&P Global and author of The Prize and the Quest, both books that are in my living room bookshelf. Danny, Anis?
Yusuf, thank you for bringing us that conversation. That is Bloomberg's Yusuf Gamal Aldin. Thanks so much. All right, coming up, we're going to speak to Elliot Hentov of State Street Global Advisors to discuss the averted U.S. government shutdown. Is it just averted for now? Is drama still to come? All of that next on Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Now, Congress has averted a government shutdown at least until November 17th. Joining us now to talk about it is Elliot Hentov, head of macro policy research at State Street Global Advisors. Elliot, great to have you on the program. Great to have you on set. Look, one of the possible consequences of this shutdown is that House Speaker Kevin McCarthy is going to be challenged. Usually investors don't really care about who's the House Speaker, but should they this time if it means he might be replaced by someone on the more far right?
The worry is less about the replacement and about process. I know this is boring parliamentary procedure, but in this case, theoretically, if he does get removed, no other business in Congress can take place until a new speaker takes hold. Given that there's no agreement on an alternative, that process could take a long time, which is why my hunch is that the Democrats would probably keep him in place, and that would probably be enough to sustain his speakership. Given they had the debt ceiling deal back in June, I presume that was always kind of part of the plan B, so to speak, and therefore McCarthy has surprised all of us with the confidence to kind of challenge the fringe of his party.
But that fringe of the party are going to keep going. They're going to keep challenging McCarthy, one would think. Good morning to you, Elliot. Good to see you. Here's the issue. We're in this extend and pretend zone. We've got 40-odd days to run. We're going to be back at it again. And it's going to be Ukraine versus border security is going to be top of that agenda. What is it that the market is not getting about the situation in Congress at the moment? The fiscal situation is something that you highlight.
Well, I think the market is getting what's going on in Congress. Namely, we have a very loose fiscal position. We have a very tight monetary position, and therefore the currency strengthens. And that's exactly what we've seen. What I think the question mark is, how long is that sustainable? You're running... This is a growth period. The U.S. economy is actually doing fairly well, and we have a deficit running at close to 8%. That's obviously not sustainable. So the question is, when do you get the fiscal drag kicking in? And once that kicks in, it's probably going to happen at a similar time as yields peak, and therefore you also get the kind of the inflection point for the dollar on the FX market too. But when is the big question mark?
What happens when we do get there, though, and we have that inflection point at a time where we've already been spending so much? It seems like we're almost out of ammo to really help the U.S. economy if we get to that inflection point. Is that fair?
Clearly, we're out of ammo in terms of, can you get more fiscal expansion?
Yeah.
I do not think so. You already have 10 years barreling towards the 5%. At some point, financial conditions will get too tight for the economy to keep growing. So, yes, we must be nearing that point. It's a little bit like a rubber band. We're pulling it and stretching it. We all know you cannot stretch it indefinitely. One thing's clear. After the election at the latest, you're going to get a serious fiscal consolidation in the U.S., and that's going to obviously also be a headwind to growth.
Elliot, there's a chart that we use quite often, which is about the amount of interest that the government is paying on a regular basis. We're now looking at the cost of debt at $1 trillion. I like what Bank of America had to say, which is yields rising, the cost of debt servicing rising, the losses, if yields went to 5%, would be around 50% in 3 years. So we move from this U.S. exceptionalism to U.S. debasement. What would U.S. debasement look and feel like?
Yeah, so if it was an emerging market, we know what it would feel like. Foreign investors would leave, the currency would depreciate, yields would shoot up, and until they got to a level where it's attractive again. Now, with a reserve currency issue like the dollar, that's a very different dynamic. Here, what happens is you do gradually get a rise in yields until the point where financial conditions tighten and growth starts to slow down. And so the U.S. economy eventually suffers from the costs of servicing the debt burden, and basically trend growth starts to decline. And that frankly, is a little bit of a worry going into the future, unless some of the fiscal spending we've seen has gone into productive investment. Is it really all going into manufacturing and semiconductors and industrial chips and high tech? Well, then maybe we actually will be surprised, and the productive capacity matters.
Okay.
You showed that chart. That chart on its own doesn't matter. You have to measure it relative to the revenue of government. And that chart looks scary right now because we see the steep rise.
Well, there's also this warning from Ray Dalio that, okay, you have all this issuance and someone needs to buy it. And at the same time, we have bonds coming from the Fed, too. We're engaging in QT right now. Is there a point at which the Fed changes course, maybe even restarts QE, even buys bonds with this deluge of supply?
Danny, thanks for setting me up with that one, because actually I had posted a note to clients earlier this year thinking that by the end of the summer QT would end precisely for that reason, because the massive issuance after the debt ceiling deal and continued balance sheet runoff would make long-term yields just simply too expensive. But the problem is the communication. How does the Fed pivot on the balance sheet without signaling that the rate cycle is over? And so in many ways, they've built up this conundrum, and frankly, I do think QT will have to end fairly soon.
OK, well, that's the US side. Let's travel across the pond for you, because today the UK Chancellor Jeremy Hunt, he caught up with the Bloomberg team. Lizzie Burden was on the ground on the sidelines of the Conservative Party conference, Elliot. So let's take a listen to how he set the agenda.
If we want faster growth and also an end to taxes ever ratcheting higher, that is possible, but there are no shortcuts. We have to spend taxpayers' money more efficiently. We need to reform the welfare state. Those are difficult decisions, but they are decisions that Rishi Sunak and I are willing to take, because the choice in British politics is between a party that does want to bring down the tax burden and the Labour Party that doesn't.
So, Elliot, the top line of that conversation really was there's no room for any tax cuts. A year ago, we were dealing with Trustonomics, Kwasi Kwarteng and Liz Truss. Here we are with a Bank of England whose hands are tied behind their back with rates at the moment. The sterling is under considerable pressure. Fiscally, when you look at the situation in the United Kingdom, how much tighter? Does the tightening come fiscally in the UK ahead of everywhere else?
I would say the policy pivot in the UK over the past 12 months has kind of front-run and released some of the pressure valves. So no, I do not think the situation in the UK is any more acute than elsewhere. The problem is, though, that because the sensitivity to bond markets is so high here, the government has to tread carefully about signaling any type of loosening of the fiscal position. So it's a delicate dance. And that's what makes the UK a little bit more sensitive vis-a-vis the markets.
Yeah, we don't want any more lettuce offs, lettuce timeline offs, whatever the phrase for that is. I think we hope we're past that period. Elliot, I'm afraid we're going to have to end it there. Thank you so much for joining us. That is Elliot Hentov, head of macro policy research at State Street Global Advisors. Now, later today, we're going to talk again about the Congress showdown with the man himself, Congressman Matt Gaetz. That will be on Balance of Power at 5 p.m. Eastern. Coming up first, though, on this program, a look at some of the market-moving events for you to watch throughout the week. Here's a quick check on your markets as we head to break. We are getting that risk on bid, but the bad news, Treasury yields moving higher. How much of that is about supply? 4.6% on your 10-year yields. This is Bloomberg. Welcome back to Bloomberg Brief. I'm Danny Berger in London. Managed Cranny is in New York. All right, let's get you set up for your trading week. We get a deluge of data leading up to the main event, that is Jobs Day on Friday, plus a host of PMIs coming from Germany, France, Italy, and Spain. Those will hit on Wednesday. Now, on the monetary policy front, we're going to be getting more central bank decisions. They will come out of Australia and India. Are we going to see a very same tone of the hold and wait from the Fed and now the ECB? Plus, Chair Powell's roundtable discussion at 11 a.m. Eastern. Then there's President Lagarde's remarks on Wednesday. Man, this will be interesting to see if they're comfortable with where yields are or if that tightening condition means they want to talk down markets a bit.
Yeah, I mean, it looks as if the Bears are still in charge of those bond markets this morning. We'll tap into the zeitgeist of where we are with tens in just a moment. There's a couple of other stocks we should be watching. Danny, just on the market, you got Microsoft. You got the CEO there, Satya Nadella. He gets set to take the stand today as part of the Justice Department's antitrust trial against Google. And then, of course, we've touched on this, haven't we? Tesla, haven't we, Danny? Record car delivery streak could come to an end in the third quarter. Analysts at Bloomberg predict 456,000. I know you've got the other numbers in front of you there. 456,000 for the period, lower than the previous of 466. But what else have we got, Danny?
Well, we're also watching crypto. I feel bad taking this from you, Manus, because you did Bitcoin today. But anyway, crypto stocks are higher. There's that crypto rally. The hope is, as you mentioned, Manus, I literally learned this from you, that there is more optimism that the SEC is going to approve a spot Bitcoin ETF from BlackRock. So that's got Bitcoin excited and the individual stocks themselves. But take it away, Manus, on the treasuries. I just thought we'd frisk it up with a little bit of Bitcoin. Quick snapshot of what's going on in the bond market. The Bears are in charge. There you go. There's nothing. The hurricane continues. The vigilantes are alive. And SocGen joined Bloomberg Brief this morning with a call of 475 on treasuries, Danny. So these bond markets are erupting higher. There's a lack of belief that we're in an extend and pretend period in the U.S. situation for shutdown.